Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Rivian came public to a lot of fanfare less than 2 years ago, but right now it seems like the company's best strategic option may be starting to look for buyers for the company. I don't say that lightly. I bought shares of Rivian recently. I thought the company's products were really compelling. They had a ton of cash on the balance sheet, and they had demand that expand well into 2024. But a lot of that's actually falling apart. We're seeing recently that you can now get an R1T vehicle in as little as 2 weeks, indicating that there's not actually a lot of pre-order backlog. Rivian started taking out debt, so now has $2.7 billion worth of debt on the balance sheet to go along with $12 billion worth of cash. They're burning a lot of cash, between $1 and $2 billion each quarter. And with only about 50,000 vehicles expected to come off production lines this year, the company is nowhere near cash flow positive. So it's going to be at least probably 2 years from now before Rivian would get to any sort of positive cash flow. And the company might simply run out of cash by then. Then there's becoming fewer and fewer options for raising more money, especially as the stock declines. So why is this a good time to sell? Well, let's go through a couple of the numbers. Before we get there, my name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content and turn on those notifications as well. One thing that I want to highlight is Rivian's current market cap, $12.65 billion according to Google Finance right now. That is offset by about $12 billion in cash on the balance sheet. I'm going to actually go down here to the full numbers, $11.2 billion worth of cash as of March 31st and $2.716 billion worth of long-term debt. So a solid net cash position, but remember that Rivian burned $1.5 billion in operations in the first quarter, and that's on top of $283 million worth of capital expenditures. So the run rate there is getting close to $6 to $8 billion worth of free cash flow burned on a yearly basis. As a standalone company, Rivian has to contend with trying to get its operations to cash flow positive as a lot of competitors come onto the market. So it's really fighting multiple battles. It's fighting just to keep itself afloat, trying to get to sustainable operations, as it's trying to make sure that a lot of these legacy automakers don't kind of come over the top with bigger, better products at lower prices that can be subsidized by cash flow that's coming from elsewhere. I think one of the things that Rivian could do is try to sell it to one of the automakers that doesn't have a big presence on electric vehicles and maybe wants to get specifically into electric trucks and SUVs. So maybe an automaker like Honda or Toyota. Those could really be compelling buyers for the Rivian brand and also give them a presence in the US where they don't have to have dealers, don't have to distribute through dealerships the way they do with their traditional business. I don't see GM and Ford probably buying a brand like Rivian because they have a lot of competing products that they're going to want to sell as opposed to adding another adjacent brand. But I don't say this lightly, that I don't think that the future for Rivian actually looks very positive. I only see cash burn in their future. And right now, the indication is that demand for electric vehicles, and specifically the R1T, is probably a lot lower than people were expecting even 6 to 12 months ago. If we go into any sort of recession, if interest rates continue to rise, if financing keeps pulling back, remember that a lot of people are financing their auto purchases, and we've seen bank after bank either exit the auto business or say, we're going to have to give lower loan to value loans, basically meaning that people are going to have to put more down payment on purchases. The result of that is going to be lower demand for vehicles, specifically at the high end. So once you start getting to those $70,000, $80,000, $90,000 vehicles like Rivian is producing, that's where we're seeing demand fall off first. We've seen that at Lucid. We've seen that with Tesla's Model S and Model X. And now I think we're starting to see signs of that at Rivian. They're not giving a lot of disclosures, but if they're not able to sell everything that they produce in 2023, that's going to be a massive warning sign. I think it's already time to start looking for a potential buyer, looking for a way out. They still have a lot of cash on the balance sheet. There's a lot of equity in that brand name, in the production that they're building out in the US. But I just don't see the future as a standalone company being very bright. I may actually sell my Rivian shares in the near future as a result at a small loss. I just think the news has gotten worse and worse as the year has gone on. But what do you think about Rivian's position right now? And what about potential buyers? Who could potentially come in and pick this company up? Love to hear your comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.